Japan has just taken one of the most decisive steps in the history of cryptocurrency regulation. This week, the Financial Services Agency finalized a complete overhaul that will move virtually all crypto assets out of the Light Touch Payment Services Act and place them under the much stricter Financial Instruments and Exchange Act, the same law that governs stocks, bonds, and investment funds. For the roughly 13 million Japanese crypto accounts holding over 5 trillion yen in assets, this is a seismic shift. Here are the 5 pillars you need to understand. First, exchanges will now be required to maintain dedicated liability reserves. The size of these reserves will be calculated based on trading volume and the operator's history of incidents. The goal is simple. If a hack occurs, like the DMM Bitcoin breach last year that cost users more than 4,500 BTC, exchanges must have cash or liquid assets on hand to make customers whole immediately. They can also use insurance policies to meet part or all of the requirement. Second, customer assets must be fully segregated from the exchange's own funds. In the event of bankruptcy, a court-appointed administrator or licensed attorney will be authorized to return those assets directly to users, bypassing any prolonged creditor process. Third, disclosure standards are being dramatically strengthened. Token issuers, especially those running centralized projects, will have to publish detailed information on supply limits, issuance schedules, governance structure, technical risks, and project roadmaps. The era of vague whitepapers and anonymous teams targeting Japanese investors is effectively over. Fourth, unfair trading practices and insider trading are being explicitly criminalized under the new framework. Anyone in possession of material non-public information about a listed crypto asset can face the same penalties as someone trading on insider information in the stock market. Fifth, enforcement is being sharpened. The FSA will gain broader powers to issue cease and desist orders, impose heavier fines, and block unregistered overseas platforms that solicit Japanese residents. Perhaps the most interesting long-term consequence is what this reclassification enables rather than restricts. By treating major cryptocurrencies as financial instruments, Japan is clearing the path for regulated crypto ETFs, publicly offered investment trusts, and institutional products. Many analysts expect taxation to shift as well, moving crypto profits from the punitive, miscellaneous income bracket, which can reach 55%, to a flat 20% capital gains rate identical to stocks. The industry reaction has been mixed. Investor protection advocates have praised the measures. Exchange operators and local blockchain associations, however, warn that the compliance burden could be existential. The president of the Japan Blockchain Association went so far as to say that the industry may not survive the proposed measures in their current form. Whether those fears prove justified remains to be seen. What is certain is that Japan, with one of the largest pools of household financial assets in the world, is deliberately positioning itself to become a global hub for regulated digital asset investment. This is not the Wild West anymore. Tokyo has just drawn a line in the sand. Innovation is welcome, but only if investors are protected with the same rigor applied to traditional markets. If you found this breakdown useful, please hit the like button and consider subscribing so you don't miss the next major regulatory move. Thank you for watching, and I'll see you in the next one.